Hello, everybody. We will be talking about Paramount stock today. So they have been kind of a mess for a while now. They're in talks to be bought out. A bunch of deals were given. None of them have been accepted yet, as far as I know. I mean, the stock price would probably be a lot higher if it was, but they kind of have been declining in terms of like the whole TV ad revenue business for a while now. Their other businesses are sort of doing better, but not really picking up the slack as much as they could be. So there's a lot going on with them, a lot that could possibly happen with some potential things, but let's just get into it. Full review. Make sure to subscribe and Paramount. Yeah. All right, so let's get right into it. Cost of capital looks pretty good. Target price is above. Long-term growth rate looks real nice at 43.8%. Now, I don't know where they're getting that number from, but one thing to note is if you look right in this area, you could see the compounding growth of a bunch of their metrics, and EBITDA's not looking good. Net income's not looking good. Dividends are going to decrease, apparently. Free cash flow decreasing. So I don't know where they're getting that long-term growth rate from, but cannot possibly be that high. I guess for the industry as a whole with media, it makes sense, but not so much for Paramount. So let's zoom out here a little bit and see their sales. So you can see sales have been declining for 2 years, set to decline in 2024. It looks like they haven't really, considering they're at 28 now and they were at 27 6 years ago. That's not too crazy. It's been decreasing for 2 years straight and hasn't seen a significant increase in 6 years. So not great there. Operating income was negative last year, supposed to be well below where it was in 2022, way below where it was in 2021, despite similar amounts of sales. So that is pretty bad. Net income going to be massively negative, enormous. Apparently, they're going to lose almost 6 billion this year, which is crazy. EPS, obviously, same story, much more negative. Total shares looks like they are starting to bankroll with dilution, which I mean, it makes sense, but you don't want to have to see it happen. But looks like 2018 they massively diluted. That's crazy. Yeah, it looks like they're bankrolling with dilution. If I had to guess, I mean they're, especially the past year, they're set to add over, was that 14 million more shares? That is not great. So, I mean, income statement does not look fantastic. Maybe the balance sheet will be a little better. Cash has actually been decreasing for 2 years. Now, is that for lowering debt maybe? Oh, actually, yes, it is. It looks like they've been lowering long term for 4 years straight. Short term is at a 4 year low, which is definitely something. Their cash can easily cover their short term, which again is also what we're looking for here. Assets took a very large hit in the past year, and I'm assuming if we go into the quarters, it will be the same story, and it looks like it is. They're at 46 billion now after a high of around 58. Yeah, 58, which is not great. Not really a good thing. Short-term debt, though, is minimum. Both, they've been decreasing their long-term for a few years now, which is definitely something positive. I can't imagine retained earnings are positive. And actually, they are, shockingly. Now, they have been using some of that. In the past year, it decreased by about a billion, but still very positive retained earnings, which is good. So in terms of balance sheet, they're actually looking fairly solid other than selling off a lot of assets, which again, I fully understand because when you're in a situation like this, you kind of have to do that, keep what's profitable, sell off what isn't. So that does make sense. Operating cash flows actually look pretty good, at least for the past 3 years. Nearly all of it is from funds and operations. Now, changes in working capital, inventories are ruining their operating cash flow. They are spending so much on inventories, but still operating cash flow looks good. Investing cash flow looks like they are other funding it. Again, I can't really define exactly other funds, but basically they are getting a lot of money from that. So if their cash flow is positive, which it is, it's mainly because of their investing cash flow being positive. And also, obviously, they're operating as well, but still. So financing is actually negative. And again, it's because of the massive amount of debt reduction they're doing, which I love. That is fantastic. And then free cash flow again, 2 years of increases, which is good objectively because they are sort of bankrolling it with some asset sales. You can see sales of fixed assets and businesses there, but also they are purchasing investments. So that is also something. But again, their assets have massively declined. And I think this other funds has to do with that. So overall, not terrible for the cash flows. Let's look at the use of cash. So debt issuance, again, they've been repaying for a while, which is really good to see. This is actually the quarters. Let's go into the years. Again, some issuance, but more repayment, which is surprising, but really good. And then obviously they have been issuing a lot of equities. They issued $3 billion worth in 21, which is a lot considering the company is, I forget what their market cap it is, but it is not 3 billion, or it is like 10-ish, but still 3 billion is a lot compared to it. Repurchasing of stock, we used to see it. They stopped in 21, issued a ton of equity, and have not repurchased since. So there is that. Let's head to the ratios, see how we're looking here. So SGA to sales honestly is not terrible, although it has been increasing for a while. It is steadily increasing since 2017, which I do not like. And considering sales are not doing so well, that is not great either. Net margin just turned negative. Let's see if they fixed that on the quarters. Maybe, possibly. And no, it is massive declines. Okay. Zero there. ROA, ROE is going to be the same thing. Very large declines. They actually haven't been positive on those in a while, since 2022. So that is kind of abysmal. In terms of long-term debt to equity, it's actually not as high as I would have expected. Again, we're in the quarters. Let's look at years. Not crazy high as I would have thought. Now in 2024, it did increase again, but I'm going to give them the benefit of the doubt and look at the years here and see that it went from 86% to 70%, which is not bad. 70% is a fairly healthy debt to equity ratio. It usually 80% is like the upper limit, or actually like more ideal, under 80%. So this is really solid. So Overall, 12 out of 23, 44% for Paramount. That is not as bad as I was expecting at all. Not saying they're massively outperforming, but not too bad. Let's get into some specifics. So I did not look at this yet, but this is from their last earnings report. So underperformed on TV. Direct to consumer was right in line. Looks like advertising outperformed a little bit. Filmed entertainment was way below, which is not great. And then I do not know what I'm assuming OI is operating income. Um, Looks like an underperformance. They actually outperformed here. They were expecting a loss, and direct consumer actually had a profit, which is good. And then filmed entertainment was a very slight beat. Free cash flow was very solid. And then Paramount Plus subs actually outperformed a lot. So that is not bad at all. Obviously, some revenue metrics missed, but overall, for what I would say are a little more important things like direct to consumer beating by $200 million is really solid. Filmed entertainment, that's only $1 million, but it was still a beat. And free cash flow outperforming, subs outperforming, which is very, very important nowadays. Everyone wants to know how many monthly active users you have and how many subscribers. So it is really good to see that they outperform there. Let's take a look at the stock price and see that they have not done well since that earnings report. They have actually dropped a lot. If we head into the weeks, we can see 4% this week, 2% the week before, but that's also including the growth they had before the earnings. So I'm assuming there was a lot of hype for the earnings report and it did not end up well for them. But overall, I mean, you could see their chart. It is not good. I don't know what happened. Right. Sorry for the scrolling around. I don't know what happened 2020. Oh, I know that wasn't even COVID. I I really don't know what happened to them. I forget what the news was. I believe it was a possible bankruptcy and that they would possibly be bought out, but I'm not exactly sure. So that excuse me, that is why there is so much volatility now in the stock because they are in talks to be bought out and they have been for a while now. And it keeps either getting slowed down or delayed, or there's different offers or different companies making offered. And the entire time this is happening, their stock price is declining a lot. Now, with this earnings report recently, it is pretty solid, at least from what I saw. So, some positive things there. Maybe they'll start turning it around a little bit, but we will have to see in the near future what happens. Right now, it looks like they are in a bit of a free fall, at least over the past few days, dropping just about 10%, almost 10%. So, not too great there. But anyway, I think that's it for Paramount. Hope you enjoyed. Hope you got something. Make sure to subscribe if you haven't, and I will see you next time.